There are two recession indicators that we've been following closely for the last year and a half. The first is the shape of the U.S. Treasury yield curve and the relationship between the 2- and 10-year Treasury spread, and the second is the year-over-year job growth numbers. So what are these indicators telling us today? Historically, the yield curve has been a very good leading indicator for future economic growth. A yield curve is a line that plots the relationship between interest rates and the time to maturity. On this chart, we show two yield curves. The green curve indicates where Treasury rates were in December of 2013. At that time, the shape of the curve was upward sloping from left to right, indicating the bond market was expecting positive economic growth. The 2-year was yielding 0.5% and the 10-year was yielding about 3%. The spread between the two was 2.65%, indicating a relatively steep curve. We generally see this type of yield curve during periods of economic expansion, when the economy is growing at a solid pace, and there's a healthy amount of inflation, and companies can get easy access to capital. But there are times, however, when the curve's shape deviates, signaling potential turning points in the economy. In September of this year, represented by the blue line, the yield curve was very flat. The reason for the flatness of the curve is because the market is concerned about future economic activity, not only here domestically, but also internationally. And in fact, there was a very short period of time at the end of August when the yield curve inverted, meaning that shorter rates were yielding more than longer rates. And why is that important? When the 2-year Treasury and the 10-year Treasury invert, it's been a very good predictor of recessions. On this chart, the pink horizontal lines show when the last 5 recessions occurred in the United States. The black line shows the yield spread, and the red horizontal line indicates the break-even level. For example, if we look at the late 70s, we can see where an inversion occurred. It was a period of time when we had oil embargoes, high energy prices, and high inflation. So the Federal Reserve came in, increased interest rates to combat inflation, and ultimately inverted the curve. A recession followed in 1981. In the late 80s, we had the savings and loans crisis. The spread inverted, and a recession followed in 1990. Then in the late 90s, most of us remember the dot-com bubble bursting. We had an inversion and we were in a recession in 2001. Then in 2005, we had a very small inversion. It was quick and wasn't very pronounced and turned positive. But in 2006, it reinverted and we had the Great Recession of 2008-2009. So where are we today? We've seen the spread come down significantly from 2013 when it was about 2.5%. As of the end of September, it was down to 4 basis points. And in late August, we had an inversion that lasted for about 7 days and was inverted by 5 basis points. So this is an indicator. It's raising a caution flag to us. It hasn't given us the confirmation that we're looking for in terms of the coming recession, but it's certainly telling us that it's time to be on the lookout for a recession around the corner. The second indicator we've been following rather closely is job growth. Going back to the 1980s, again, the red vertical lines are where we've had recessions. You can see when year-over-year job growth declines below 1%, it typically coincides with the start of a recession. If you zero in on the last 8 years, going back to 2011, you can see we've had a very healthy period of job growth. In fact, if we look at 2018, we're creating about 240,000 jobs each month. But recently we've seen that slow down this year. We're creating about 130,000 jobs each month. If we see year-over-year job growth fall below 1%, that will give us a confirmation we're looking for that a recession is coming. Another economic statistic we look at is wage growth. We've actually seen very strong wage growth recently, but back in 2014, we didn't have much wage growth to speak of. This was a conundrum for most economists, as unemployment rates were falling, but wages were not increasing. In fact, we were seeing about 1.5–2% increase year over year, which is basically keeping up with inflation, but not keeping up with the cost of living. Since 2018, we've seen a rather significant change, averaging almost 3–3.5% year-over-year growth. So if we think about GDP growth going forward, consumer spending makes up about 2/3 of that. So if we have a healthy consumer, workers have more money in their pockets, and they're spending, we think that will push off any recession, at least in the short term. This has not been a very good year for manufacturing in the United States. Manufacturing makes up about 11% of our economy. We've seen dips before. From 2015 to 2016, we saw a large, significant slowdown. It was a period where demand dropped off as oil prices were falling, manufacturing slowed, but ultimately we did not end up in a recession. Looking at manufacturing around the world, both for developed and emerging countries, we can see that the slowdown is not isolated to the United States. The red shows contraction, where manufacturing has slowed, and the green shows expansion, or growth in those specific countries. So if we go back to 2008, 2009, it shows that most of the world's manufacturing was slowing because of the financial crisis. We came out of that period and saw mostly green, with the exception of Greece. Greece had a debt crisis during that time, and that spilled over to some of the other countries, Spain, Portugal, and Italy. If we move forward to 2017, 2018, we saw pretty significant expansion in both developed and emerging countries. But today we're starting to see some of those colors change from green to more orange and red. If you look at Germany in particular, they are in a manufacturing recession. So the question is, if we have a global manufacturing slowdown, is that going to spill over to the rest of the economies? Today's headlines are dominated by the trade war, and it may feel like tariffs are being put on nearly every product. However, this chart indicates that today we are at level 4, which equates to about 5% of global imports having a tariff. If you put that in a historical context, going back to the early 1900s and 1930s under the Smoot-Hawley Act, we put tariffs on about 20% of our imports. Even Trump's proposed tariffs are relatively small as a percentage of total imports. We don't think that tariffs by themselves are going to have a huge impact on slowing the economy. However, we do think that the uncertainty around where tariffs are going is having an impact on business investments and investor sentiment. The federal funds target rate is the rate that banks lend to each other overnight. The Federal Open Market Committee, today headed by Jerome Powell, controls and manages this rate. It is one tool they use to promote a strong economy and moderate long-term interest rates. When the economy gets too hot, they increase this rate to slow it down, and during a recession, they decrease it to encourage economic activity. We can see back in '99, when then Fed President Alan Greenspan raised rates during the irrational exuberance of the dot-com era. When that bubble burst, the rate declined until it was ramped up again in 2003. When the financial crisis hit in 2008, the rate was brought to a band of 0 to 0.25%. It stayed there until 2015. Through 2018, we saw 9 rate increases, but this year, the Fed has reversed course and cut interest rates 3 times. The Fed manages this rate with a tool called a repurchase agreement, also known as a repo. They sell Treasury bills overnight and agree to buy them back at a slightly higher rate the next day. On September 16th, we experienced a large fluctuation in the federal funds rate. This was caused by a very large amount of tax payments that flooded the banking system, and the federal funds rate went from 1.75% to about 10%. The constraints in the financial system that have been brought about from the Dodd-Frank and other regulations that occurred post-financial crisis have made money markets very sticky. So the Fed flooded the market with a significant amount of cash and brought the rate down to the target range. In the aftermath of the financial crisis, interest rates were near 0%, yet the economy was possibly diving into a depression. To stimulate the economy, the Fed instituted a new program called quantitative easing. Essentially, they injected cash into the banking system by buying longer-dated mortgages and treasuries. In 3 steps, QE1, QE2, and QE3, the Fed balance sheet increased from $900 billion, where it was for decades, up to $4.5 trillion. Since then, they've let some of those securities mature, which has brought the balance sheet to $3.8 trillion. That's a lot of money to flood the economy, so we wondered, where did it go? Well, where it's been and where it's stayed is in the banking system. Dodd-Frank insists that they keep money in reserves because the banks didn't have enough reserves before the financial crisis. So they flooded the market to secure the banks, but it hasn't really stimulated the economy. This is significant because it's very long-term and it's very brand new. Both the ECB and Bank of Japan have adopted this strategy, and that has precipitated something internationally that is very perplexing. These are the yield curves as of September 30th in Japan, France, Germany, and the United States, showing the level of interest rates from 1 month to 30 years. The US market has got anemic yields, but we are the high yield market, which is really odd because we're the highest quality market too. At this time, there wasn't a single government bond in Germany that had a positive rate of return on its yield. We believe that's occurring because quantitative easing in the ECB and Japan and Great Britain has basically flooded their market with so much cash and taken so many fixed income securities away that there's not enough supply to meet the demand. Prior to 2014, there had never been any negative yielding debt. As the price of oil dropped in 2015, central banks around the world started to accelerate quantitative easing. This increased negative yielding global debt to about $8 trillion, where it stayed until 2018. Since then, we've subsequently seen an acceleration to the point where we are now at about $15 trillion. This makes up about 30% of total developed market government bonds, which is shocking. Could we see negative rates in the US? While it is certainly possible, because the Fed has taken steps to reduce their balance sheet, we believe it is unlikely. Furthermore, we had a big tax cut in 2017, and that tax cut is increasing the amount of the deficit. The government finances that deficit by borrowing money from the public markets in auctions, and they're borrowing about $62.8 billion on average a month. So we've seen a $700 billion reduction in the Fed's balance sheet, and concurrently an $800 billion increase in the U.S. Treasury borrowings, and that combines to create a $1.5 trillion reduction in currency in circulation in the United States. If this continues, we think we're going to continue seeing the U.S. being the high-yield market. If we look at fixed income returns for the last several decades, we can see a steady decline in yield. This blue line shows the nominal yield on the 10-year Treasury. The green line shows inflation, and the red line shows the difference between the two, or the real rate of return. In the 1980s, bonds were returning as much as or even more than stocks. In the 90s, the 10-year Treasury was yielding high single-digit rates of return. And here we are today, with effectively a decade of that 10-year Treasury bond yielding below 2%, while inflation has been bouncing around about the same level, resulting in a real rate of return near 0%. While fixed income has been very attractive historically, in this environment, it's going to be challenged to generate a real rate of return, certainly over the next 12 to 18 months. The other type of investments that we use is the equity markets. Equities have several different ways you can generate a return. One of them is the change in price that an investor is willing to pay for the earnings stream of a company. Looking at a timeline that goes back to 1994, extending all the way to today, this black bar shows the price to earnings ratio on the S&P 500 over those different periods of time. We recall back in the late 90s, early 2000s, investors were being called euphoric. They were willing to pay a very high valuation, a high price to earnings for that earnings stream. The reverse was coming out of the financial crisis. There was more pessimism in the markets, and investors were not willing to pay a high price to earnings for those earnings. Today we are right at the 25-year average, meaning investors are not particularly optimistic or particularly pessimistic. And so we look at some of the things that investors are worried about, whether it's some of the economic data, some of the monetary concerns, or some of the other issues that we have going on globally. We have Brexit, we have a tariff war going on with China, and we have a little election coming up in about a year that will garner some headlines, driving investors to either be optimistic or skeptical, depending on which way those headlines run. So we don't think that we're going to get as much return from an increase or negative return decrease in valuation. So the other side of that price to earnings ratio is the earnings. And in the absence of paying a higher valuation for those earnings will have to grow. And so we looked at how we think we're going to get earnings growth over the next 12 months. This is a timeline that starts in 2000 and goes to the second quarter of 2019. Each color is showing a contribution to earnings growth from three different factors. The gray bar is margin, so the profit margin companies are able to get for $1 of revenue. The olive color bar is revenue growth, how many dollars the company is able to make. And the last, the light blue bar, is share count reduction. Companies can increase their earnings per share by buying back their stock and reducing the number of shares outstanding. In 2017, we had margin growth as companies were able to pass along price increases. The olive bar, revenue growth, also increased, which is a very good environment for earnings growth. In 2018, we had a big contribution from the tax cut that boosted net margins for companies across the board. So we had 2 big years of earnings growth, which allowed valuations to stay relatively in line with those historical averages. For 2019, we've continued to see earnings grow, but not nearly at the rate that we've seen. Looking ahead 12 months, if we have economic headwinds from manufacturing data and job growth numbers, are companies going to be able to get the revenue growth in order to see their earnings grow? And if they're not getting that revenue growth, are they going to cut their prices, which would put pressure on their margins? If companies are challenged to grow their earnings and we have a static valuation, we're looking at a flat stock market over the next year. Analysts today think that in 2019, we'll have around low single-digit earnings growth, but there's much more optimism into 2020 and 2021. We think that the market may be overpricing the future growth rate of earnings a year out and 2 years out. In the absence of earnings growth, we're looking where we're going to get return in the equity markets. A year ago, we were talking about how interest rates had finally crept up above the dividend yield. This chart goes back to 2014 through the end of September. The blue line is the S&P 500 dividend yield, and that's bounced pretty consistently right around the 2% number, creeping up a little higher when the market's down, coming down a little lower when the market goes up. The green line is the 2-year Treasury yield. Back in 2015, the 2-year Treasury yielded a little over 0.5%, but it crept as high as 2.9% in 2018. So finally, we're going to get some compensation for the risks that we are taking by investing in the fixed income market and an income that surpassed that of the S&P 500 dividend. But as the Fed has lowered rates and some of these economic concerns have crept in, those yields have come down as well. We're back in the relationship that we're getting more income from the S&P 500 than we're getting from the 2-year Treasury bond. And that's the other component of return in the stock market. We talked about changes in valuation, we talked about earnings growth, but the third contributor is how much money companies are returning to their shareholders in the form of dividends. This chart shows how 2 different types of stocks in the S&P 500 have performed. In the last decade, we've seen growth-oriented names, such as the FANG stocks, surpass the return of value-oriented names. A growth-oriented name is a company whose return we're expecting to get from that change in valuation, or higher earnings growth relative to the market. They take their earnings and redeploy them in the business. Conversely, value stocks have more predictable businesses with consistent earnings streams that are generally returning more money to shareholders in the form of dividends. So different types of total return, but looking to effectively achieve the same goal, perform for their shareholders. Historically, growth and value names have performed more in line, but we saw these start to separate back in 2011. Growth stocks have been accruing a return a little over 14% over the last decade. Value names have also performed well, but only accruing 10 to 11%. So there's been this disparate return between growth names and value names. That's led to a change in how they are priced relative to their historical averages. This green line shows the growth side of the S&P 500 and depicts the price-to-earnings ratio over that same decade. The blue line is the value side of the S&P 500, similarly showing the price-to-earnings multiple. The rise in the growth stocks has meant that the price-to-earnings ratio is much higher than historical averages. But the value side of the equation is much more in line with that historical average. So, as we're looking to deploy our investments in client portfolios, we're finding more attractive names in value stocks than growth stocks of the S&P 500. We've been following this relationship, and we've recognized it. So we've started to make tweaks in your portfolio. Now, growth and value are difficult to define, as they're in the eye of the beholder. But on the margin, what we're looking at is the relationship between price-to-earnings ratio of a company and the dividend yield, looking to get a greater portion of our total return in the form of dividends. So, in the financial sector, we sold Silicon Valley Bank, a very good bank that we had a successful investment in, but it wasn't returning any money in the form of dividends. Its business was more early-stage companies with merger and acquisition activity or successful IPO markets. And we redeployed those proceeds into Charles Schwab. Schwab, historically a growth name, has transitioned their business to look more like a traditional bank. We think the market has become overly pessimistic as to the growth opportunities that Schwab has. And while they're going through this transition, they're returning almost 2% of their value back to shareholders in the form of dividends. In the technology space, Microsoft, again historically a name that we would consider growth, trading at a very reasonable valuation relative to their technology peers and paying a 1.5% dividend. We trimmed 2 names, successful investments in Akamai and Salesforce, that were much more highly priced and not returning any money in the form of dividends. We trimmed an industrial name, Roper, and added to 2 sectors that are historically more value-oriented in utilities and real estate. So looking at our overall portfolio, we're taking a broad look at the allocations that we have, both in fixed income and in equities. We still think there's a place for fixed income, despite the fact that we'll be challenged to get a significant positive return. Certainly not the types of returns we experienced in the late 80s, early 90s. But it's important to have liquidity on the short end of the curve in our client portfolios. Liquidity funds things like future purchases and distributions, and that's a very individualized and customized process. We didn't discuss small company or international stocks from a price-to-earnings ratio or what we think their potential growth is, but we are maintaining our exposure there. We think small cap names historically do well coming out of an economic recession, and they, like their large cap counterparts, are fairly valued today. If you look at our exposure relative to peer managers, we have a pretty small international allocation, and we want to maintain that underweight relative to some of the global indices. On the large cap equity component, we are shifting some of our dollars to value-oriented names at the expense of growth names. So we are adding to fixed income, but largely maintaining our equity exposure, just changing the construction of the types of names that we are buying in an effort to get more income, which we will think will be a bigger portion of return over the next 12 to 18 months. So we've seen a yellow flag, not only in the bond market with the yield curve inverting, but also in the job market and manufacturing slowdown. This will keep pressure on the Fed to lower interest rates. As these headwinds increase, companies are going to be challenged to grow revenues and maintain historically high margins. We anticipate dividends to be a greater percentage of total return, and we continue to pivot from expensive growth stocks to cheaper value stocks. We recommend reducing equities from aggressive allocations to fixed income investments with high quality bonds on the shorter end of the curve.